welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, one of our senior analysts. So happy to have you along. Market Carver, we've got two different topics. We're going to talk about investor timing, case studies, and then we're going to talk about the frothiness in the market and give an update on valuations after we've had a little bit of an adjustment in prices. So first, I'm going to unpack some investor timing case studies because this is always so important. One of the topics we're all very passionate about and how we can make a better investment path and journey for you over time. So the current relevant topic right now is leveraged ETFs. This is a phenomenon that became new after the SEC approved these types of funds and became really big last year as the market began to boom, particularly in several of the large cap technology names. But these are exchange traded funds, not the type that you're used to, that are diversified and they either track an index or have a basket of underlying investments. Instead, they track a single investment. And usually that single stock is leveraged up to achieve either a 2-time or in some cases as much to 3 times the daily performance of that individual stock. And names like NVIDIA, MicroStrategy became super popular last year. Wall Street Journal had a great article last week, kind of summarized where these funds were. And by the way, we're not talking about really small potatoes here. These funds gathered billions and billions of dollars. In fact, when we look at margin debt, which is typically how your retail investor would try to magnify their returns in a good environment like we had last year, you would usually see margin debt tick up. We didn't see that, and we think it's because a lot of that leverage found its way inside of these ETFs. And so these are very, very volatile rides. And we must say, and all the funds will have these disclosures, none of them are designed to be held over a long period of time. In fact, they're intended to be held and traded intraday. But that's not what really happens. People hold them for a long time, and the way that they magnify them and the options and the derivatives used to achieve that leverage causes them to decay and underperform over time. So even if the stock were up 100%, whereas you might, or a retail investor might expect to be up 200% or 300 if it's 3 times, it's often less than that 100%. So very dangerous vehicle in the wrong hands. And even though we find that many of these funds are actually positive since they've been launched, most investors are underwater. In fact, we're looking at a couple $2 billion collectively in losses. So once again, this is just something that we see over time. The performance was good in these funds out the gate, so people began to pile in, push performance up, and people piled in more, so much so that the average is underwater. And as I said, this is something that we see over time. If we look at the Magellan Fund, all right, before exchange traded funds, mutual funds were really the most important vehicle of the industry. And the Magellan Fund was one of the most famous of all, ran by Peter Lynch. Those of you who are long-term investors probably know the name. He went on a legendary run from 1977 to 1990. The fund returned almost 30% per year, but in a stunning turn of events, the average investor in his fund actually lost money. He wrote that in his book, and I cited a Forbes article here where it was restated. So again, we see that even though you've got a good underlying fund, the poor investment behavior and poor timing led to actually negative results. So really crazy. And I'll summarize it in this. We've shared this in Thirdly's and probably in Market Carver's over time. It's just a summary of the last 20 years of investor timing. We can see a range of asset classes across the spectrum. You see REITs perform really well over this 10-year period, achieving a 10% annual return. Emerging market equities over that period also very strong, and so on and so forth. Commodities over the past couple of decades hadn't done much, but there were really solid returns. S&P 500, 7.5, and if we were to update it through today, of course, it'd be even larger. But if you look all the way to the right there, look at that orange bar, those are the cumulative results of the average investor. So far underperforming bonds, balanced portfolios, all of these investments. And that is because there is just too much of a tendency to flow into things that are working and then abandon them when they are not. And so much of what we're trying to do is for durable, long-term, repeatable processes that push that results closer to what you should be getting in those underlying asset classes. So I've rambled on long enough here. I want to turn it over to Zach to give you an update on valuations.
Yes, we've got a chart here that'll show price to earnings ratios of a few popular markets here, the S&P 500 in blue, the small cap market, domestic in green, and then the NASDAQ in red. What you can see here on the back of back-to-back 20% years in the S&P, valuations have skyrocketed, really. We talk oftentimes about how cheap or expensive a given market is, or the given stocks are, based on the PE ratio, which is a very common valuation metric to just tell you how much you are paying per dollar of earnings you're receiving from the underlying companies. And so on the back of a couple strong years in the S&P 500, what we noticed in domestic markets is that stocks and these indices have gotten very, very expensive. You can see all the way up at 34 for the NASDAQ, 26 for the S&P, 19 for the small caps. And with the market pullback this year, those valuation metrics have actually come down a little bit. The frothiness in the market has come off. But historically, where these indices typically lies in the mid-teens area for price to earnings. So you can see the small caps currently sitting at 15. That's the only one that's really in line with what we tend to see in terms of historical long-term average for these valuation metrics. So the NASDAQ at 29 currently and the S&P at 23 still have some room to go on the downside before we were to hit those long-term valuation multiples being in the mid-teens again. So this isn't an outright call for a bear market or anything of the sort, simply to say that there is a lot of cushion that has been built in very expensive indices over the past couple of years as these mega cap names have really run up. You're starting to see them pull back, and there may still be a little bit of room to go.
Zach, I sure appreciate it. And thank you to all of you for bearing with us for this week's Market Carver. As always, if there's any way we can be of service, whether or not we currently have the pleasure of working with you, please don't hesitate to give us a call, 800-928-4001, or scan the QR code and do so electronically. Thanks again, and have a great weekend.